Global stock markets are sending out distress signals. A symphony of red illuminates trading screens worldwide. Investors are grappling with a cocktail of anxieties pushing markets lower. The atmosphere is thick with uncertainty. The question on everyone's mind, are we heading for a full-blown crash? This is not just a blip on the radar. Major indices are experiencing significant declines. The Dow Jones Industrial Average, a stalwart of American capitalism, is reeling. The tech-heavy Nasdaq, once a beacon of innovation and growth, is flickering. Across the Pacific, the Nikkei 225 reflects the global unease. The current situation is a stark contrast to the exuberance of recent years. Easy money policies fueled a historic bull market. Now, the music has stopped, and investors are scrambling for chairs in a game of musical chairs where there aren't enough seats. The current market turbulence isn't a result of any single factor. A confluence of events has created a perfect storm. Inflation, a silent thief, has been eroding purchasing power for months, prompting central banks to take action. The U.S. Federal Reserve, tasked with maintaining price stability, has embarked on an aggressive campaign of interest rate hikes. These rate hikes, while intended to curb inflation, have come at a cost. Higher borrowing costs are squeezing businesses and consumers alike. The global economy, already grappling with the lingering effects of the pandemic and geopolitical tensions, is showing signs of slowing down. Adding fuel to the fire are concerns about a potential recession in the United States. The U.S. economy, the world's largest, is a critical engine for global growth. A slowdown in the U.S. could have a ripple effect across the globe. The U.S. Federal Reserve is walking a tightrope. Its mandate is twofold: maintain price stability and promote maximum employment. Right now, these two objectives are at odds. Taming inflation requires tightening monetary policy, but doing so too aggressively risks tipping the economy into recession. The Fed's recent pronouncements have done little to soothe market jitters. While the central bank has signaled its commitment to bringing inflation under control, it has also acknowledged the potential for economic pain along the way. This uncertainty about the Fed's path forward is a major source of market volatility. Investors are left parsing every word from Fed officials, searching for clues about the pace and magnitude of future rate hikes. The lack of clarity is breeding speculation and fueling market swings. The pain in the stock market is evident across all major indices. The Dow Jones Industrial Average, a bellwether for the U.S. economy, is down sharply from its recent highs. The S&P 500, a broader measure of the U.S. stock market, is also feeling the heat. The tech-heavy Nasdaq Composite, once a darling of investors, has been particularly hard hit. The carnage isn't limited to U.S. markets. European and Asian indices are also in the red. The interconnected nature of the global economy means that trouble in one part of the world is quickly felt elsewhere. These declines are more than just numbers on a screen. They represent trillions of dollars in lost wealth for investors, both large and small. Retirement accounts are shrinking, and the dream of a comfortable retirement is fading for many. In the stock market, investor sentiment is everything. When investors are bullish, they buy, driving prices higher. When they're bearish, they sell, pushing prices lower. Right now, fear is the dominant emotion. The CNN Fear and Greed Index, a widely followed gauge of investor sentiment, is flashing red. The VIX, also known as the Fear Index, is elevated, reflecting heightened market volatility. These indicators suggest that investors are bracing for further declines. This fear is palpable on trading floors and in online forums. Investors are questioning their long-held assumptions about the market. The buy-the-dip mentality that prevailed for so long is giving way to a more cautious approach. The big question on everyone's mind is, how bad will it get? Economists and market analysts are debating three potential scenarios: a soft landing, a hard landing, or no landing at all. A soft landing is the most optimistic scenario. It involves the Federal Reserve successfully taming inflation without triggering a recession. In this scenario, the economy slows down but avoids a significant contraction. A hard landing, on the other hand, is a recession. This could occur if the Fed raises interest rates too aggressively, choking off economic growth. A hard landing would likely lead to job losses, a decline in consumer spending, and further market declines. The no-landing scenario is the most unusual. It suggests that the economy may avoid a recession altogether and continue to grow, albeit at a slower pace. Inflation may remain elevated for longer than anticipated. This scenario presents its own set of challenges, including the risk of runaway inflation. Market downturns are a natural part of the economic cycle. What goes up must come down, as the saying goes. History is replete with examples of market bubbles, crashes, and recoveries. The Wall Street crash of 1929, the dot-com bubble burst of the early 2000s, and the 2008 financial crisis are all stark reminders of the devastating consequences of market excesses. While each of these events had its own unique set of causes, they all shared some common threads: excessive speculation, loose monetary policy, and a disconnect between asset prices and economic fundamentals. The current market environment, while unsettling, does not necessarily portend a repeat of these past crises. However, it does highlight the importance of prudence, diversification, and a long-term perspective. Section 8. The Labor Market Puzzle, a key piece. One of the most puzzling aspects of the current economic situation is the strength of the U.S. labor market. Despite slowing economic growth and high inflation, unemployment remains low, and employers continue to add jobs at a healthy clip. This disconnect between the labor market and other economic indicators has left economists scratching their heads. Some argue that the labor market is lagging, and that job losses will eventually follow if the economy weakens further. Others suggest that structural changes in the labor market, such as an increase in remote work, may be obscuring the true picture. The Federal Reserve is closely watching the labor market for signs of weakness. A significant uptick in unemployment could be the trigger for the Fed to ease its aggressive monetary policy stance. Section 9. Economic Indicators, Deciphering the Data. In times of economic uncertainty, investors and policymakers alike rely on a range of economic indicators to gauge the health of the economy. These indicators provide snapshots of different aspects of economic activity, from consumer spending to manufacturing output. Gross domestic product, or GDP, a measure of the total value of goods and services produced in an economy, is a key indicator of overall economic growth. Inflation, as measured by the Consumer Price Index, or CPI, tracks changes in the prices of goods and services. Consumer confidence surveys gauge consumer sentiment about the economy, while Manufacturing Purchasing Managers Index, or PMI, data provide insights into the health of the manufacturing sector. By analyzing these and other economic indicators, economists and investors try to piece together a coherent narrative about the direction of the economy. Section 10. Investor Anxiety, a Sea of Uncertainty. The current market environment is characterized by a high degree of uncertainty. Investors are grappling with conflicting signals from the economy, the Federal Reserve, and geopolitical events. This uncertainty is fueling market volatility and making it difficult for investors to make informed decisions. The lack of clarity about the path of inflation, the Fed's policy intentions, and the potential for a recession is weighing heavily on investor sentiment. Many investors are choosing to sit on the sidelines, waiting for more certainty before deploying their capital. This wait-and-see approach is understandable, but it comes with its own risks. By staying out of the market entirely, investors risk missing out on potential gains if the market recovers. Section 11. Weathering the Storm Strategies for Investors. Navigating a turbulent market requires a steady hand and a long-term perspective. While it's tempting to react emotionally to market swings, it's important to remember that panic selling is rarely a winning strategy. Instead of trying to time the market, investors should focus on building a diversified portfolio that aligns with their risk tolerance and investment goals. This may involve rebalancing their portfolio to ensure that they're not overexposed to any one asset class or sector. It's also a good time to review their investment plan with a financial advisor. A financial advisor can provide objective guidance and help investors stay disciplined during times of market stress. Remember, market downturns are a natural part of the economic cycle. By staying focused on the long term and making informed decisions, investors can weather the storm and come out stronger on the other side.